This video is being made to accompany your notes for Managerial Finance class on Chapter 6, Bonds. A firm's decision to raise funds is prompted primarily by its investment needs. When someone goes out, for instance, to buy a new house, they don't go commit to buying a house and then run around trying to find financing for that. Neither do they go out and find financing for an asset and borrow the money, if they could, and then look around for a house to buy. It's really sort of a simultaneous process of, first of all, getting approved for a loan. If you've ever bought a house before, you'll know the realtor will want to know how much house you can afford. They certainly don't want to show you houses for $300,000 to $400,000 when your budget will only allow a purchase of, say, $200,000. And so it is firms also. They are simultaneously monitoring their cost of capital, a term we'll use more frequently in the weeks ahead. At the same time, they are investigating a lot of, trying to develop and investigate the feasibility of a number of value-creating projects, whether it's expansion of what they're already doing, like adding additional stores, or it's maybe buying another business or getting into a very different line of business. And sometimes the value-creating measures may not involve revenue generation at all. They may simply involve cutting costs, reducing the cost, doing something more efficiently. But anyway, the financing decision is going to be prompted by the firm's investment needs. Now, firms generally prefer to finance new investments through internal cash flow, that is, from retained earnings or additional retained earnings. In order for retained earnings to increase in a period, you have to really generate profits first of all, and then not pay out everything that you earned. Dividends, distributions of profits to owners, don't represent an expense of the business. They're really a distribution of those profits. And the only way that a company can grow from within is by generating profits, first of all. And in other words, providing a service, incurring costs less than the revenues that you bring in, and also reinvesting those earnings. If a firm pays out every dime that it earns in profits as dividends to shareholders, then the company can't really grow from within. It's from those reinvested earnings that, as we see later on when we get to common equity, that's where growth comes from. Typically, that is, first of all, the first choice is for a company in financing new investments is going to be internal cash flow. One of the advantages of that is you don't have to enlist the services of anyone to help you, let's say, to obtain that financing. Internal cash flow is a function of your profitability and your dividend policy. After that, though, if you have to go outside the firm, then the company has two basic choices, debt and equity. And debt is actually cheaper than equity. It has two basic advantages. And the first one is that creditors of a particular firm face less risk than its stockholders do. Stockholders therefore require a higher potential rate of return on their investment than creditors do. So it's a matter of risk, higher required rate of return. Remember, we have a number of times this semester spoken of, I've talked about and led you through identifying or recounting the distinguishing characteristics of debt and equity. Hopefully you'll recall that debt is characterized by a finite term, meaning that when you borrow money you have to pay it back. It's characterized by fixed return, that is, that fixed interest rate that's characteristic of virtually all debt. And it represents a first claim on income and assets, meaning that year by year, creditors have to get their interest payments before you can even have profits. Interest expense is deducted from revenues in arriving at net income. So you really have to cover that cost of your debt before you can even have profits that might be, let's say, then distributed to your shareholders. Equity, on the other hand, is characterized by an infinite term. That is, when you issue shares of stock, the company is never obliged to pay back to the investor the amount that the investor paid for those shares. So we characterize that as an infinite term, a variable return, because there are no promises about what the common stockholders are going to get as returns on their investment. And so it could be a lot, it could be very little. And then finally, that equity is characterized by or represents a residual claim on income and assets. And hopefully you recall that in putting these together, I'd say the creditors have a better idea of what they're going to get, that fixed return, when they're going to get it because of the finite term of the investment, and that they're going to get it because creditors are first in line with regard to payment of interest, and of course also in terms of paying the principal amounts on the debt. If a company doesn't pay its debts, then it will eventually end up in bankruptcy proceedings. You'll have the creditors telling you how to run your business, and they don't want that. Nobody really wants that. But that's what will happen if a company fails to make good on its debt obligations. So again, we characterize debt as providing a fixed return, and is characterized by a finite term and a first claim on income and assets, whereas equity is characterized by an infinite term, a variable return, and a residual claim on income and assets. So again, what that means overall is that debt is a less risky investment or form a claim on the company than is equity. Secondly, debt is cheaper because interest on debt is tax deductible. A company can deduct its interest expenses in arriving at taxable income. This essentially means that Uncle Sam is encouraging companies to finance their operations through debt financing. I don't think any politician would say that they're doing that, but it reduces the effective cost of debt, as we'll see again some later on, and so it does in fact represent a significant advantage for debt financing versus equity financing for a business. Bonds are a prime source of long-term debt financing for medium and large corporations. You know, when a company first starts out, a very small enterprise, usually that person who starts the enterprise is going to max out their credit cards, they're going to use up their savings, they may dip into retirement, and then they may go out and borrow money from friends and relatives and such, and then eventually maybe go to a bank. But if the company does indeed grow, and eventually it will generally go public, which means it will offer its shares to the public in general. And when you've done that, that's a pretty big step upward, and it requires that the firm be pretty large to do that. The reason that a firm would go public, in this particular case, I'm really just talking about issuing debt to the public, is that they get better terms. And by terms of debt, we mean a lower interest rate and or fewer restrictions on the company's behavior. We generally think the cost of debt is really a function just of the interest rate, and that's going to be important. But there are a number of other restrictions generally that creditors will impose on the company so that the company doesn't do foolish things with the lender's money. They might, for instance, require that the company maintain certain financial ratios, especially those related to debt load or debt capacity and liquidity. But they also may restrict the firm's behavior, for instance, by saying, you cannot take out any debt that is senior to our claim. You wouldn't want, if you loaned money to a company, you wouldn't want them to go then and borrow money from somebody else and tell that person, oh, by the way, if push comes to shove, your claim gets paid before the earlier claims did. So there are a number of restrictions that that bondholders or the trustees acting on behalf of bondholders will impose on them that restricts the company's behavior, and the terms of a borrowing really is a function of all of those things, that whole package, which is in fact, it's outlined in what's called the Indenture, which is actually the contract, the covenants that guide that specify the terms of the loan. Bonds and long-term financing. Businesses generally try to do what individuals do. They try to match the term of the financing with the life of the asset being financed. If you go and buy a car, you're not going to generally buy that car and put it on a Visa card or something like that, where you owe money or maybe have to pay it back within 30 days. Neither are they going to allow you to finance it over 10 or 20 years. It's just natural for us to think in terms of financing, for instance, a car over 2, 3, 4, 5 years, something like that, which is something akin to, if not the useful life of the car, maybe at least our own personal life, useful life, that is the length of time that we plan to use that car. Short-term assets are generally financed with short-term debt, and long-term assets are financed with long-term debt and stockholders' equity. I guess here what I'm saying is that businesses naturally do what you and I do. Again, if you're going to buy a home, you're generally going to finance that over a 30-year mortgage. That's pretty standard, 15, 20, or 30 years, but 30 years is more common because that house is going to last a long time. And so companies, when it comes to financing their operations, they're generally going to finance short-term assets like inventory buildup or let's say seasonal changes in accounts receivable and such as that, with short-term debt, short-term borrowings, including vendor credit, or what we know more as accounts payable. We know that better as accounts payable. Long-term assets are generally financed with long-term debt in stockholders' equity. Of course, note there's no such thing as long-term stockholders' equity or short-term. Well, actually, all stockholders' equity is long-term. Remember, you've got the infinite term of that. There's no such thing as short-term stockholders' equity. And actually, in this next section, it's not all that critical, but the fact is companies do have long-term commitments to short-term assets. And you would imagine if it's a long-term commitment to short-term assets, that could be financed with long-term debt or shareholders' equity. For instance, I thought I'd go ahead and explain this very briefly to you. Let's say a firm has a seasonal operating cycle, and what that means is that sales vary significantly throughout the year in a predictable manner from year to year. For instance, of a company that sells a lot of its products in the summer, you might imagine they've got a build-up and high inventories in the spring, and then those inventories would fall in the summer, and maybe throughout the winter they don't have very high inventories or sales for that matter. Well, here's some information I pulled from Mattel's financial statements just recently. I got this off Yahoo Finance, and you can see here what it shows is by quarter for 2018, the most recent fiscal year, sales in billions of dollars, $1.5 billion in the first quarter, $1.4 billion in the second quarter, third quarter, 0.84. And by the way, I think this first quarter here actually is the Christmas season. You'll notice that is, it's the end of December. Probably the way these actually should be ordered is in reverse. As I recall, that quarter four there is actually January through March, and then we go to the end of the year, so that a quarter designated the first quarter is actually for the quarter of October, November, December. Yeah, October, November, and December. So you see sales are quite a bit higher in those two quarters to the left. And of course, inventory falls way down. That's the inventory at the end of December, $0.5 billion, $500 million. So you can see, but notice one of the main things I want you to see here is that inventory never falls to zero. They never have nothing in inventory. So in one sense, they've got a permanent investment in a short-term asset, specifically inventory, that of course turns over during the course of the year. But still, in terms of financing it, they've got a permanent commitment, or basically a long-term commitment of at least $500 million. And so it might make sense to see that as something you would finance with long-term financing. Well, anyway, I thought that might be interesting to you, but it's not all that critical to what we see later on. Mattel actually has a long-term investment in some amount to a current asset, so it would be appropriate to finance that long-term investment with long-term sources of financing. Okay, I'm going to pick up here on the next video.